Why central banks raise interest rates. Central banks all over the world are hurriedly raise their benchmark interest rates in an attempt to control rising inflation. But why did they do that? Unlike other public institutions, central banks are independent, non-commercial institutions tasked with overseeing a nation's, or, in the case of the European Central Bank, a set of nations' currencies. They have the sole authority to print money, regulate foreign exchange, serve as emergency lenders, and preserve the stability of the financial system. Central banks have three primary monetary policy objectives. Controlling inflation is the top priority. Reduced unemployment is the secondary objective. The third purpose is to promote the economy to have moderate long-term interest rates. If a country's economy is like a human body, the central bank would be the heart. And just as the heart works to pump blood that gives life, the central bank pumps money into the economy to keep it healthy and growing. The amount of money required for economies varies over time. How much money circulates in an economy is determined by the country's monetary policy. Primarily, there are two types of monetary policies: contractionary and expansionary. The expansionary monetary policy intends to increase the amount of money available in the economy. Promoting economic growth is the primary objective of the expansionary monetary policy. However, this can also result in higher inflation. Reducing the amount of money in the economy is the aim of a contractionary monetary policy. When the government wants to keep inflation levels under control, it employs a contractionary policy. In our earlier example, we take the central bank as the heart, which controls the blood supply. If so, then the inflation is comparable to blood pressure. Both circumstances of high and low blood pressure are not desirable. Only when our blood pressure will be at its optimum level we feel safe. The same principles apply to economies. The main objective of a central bank is to maintain price stability. This means that they must manage both inflation, which occurs when prices rise, and deflation, which occurs when prices fall. Every central bank sets a target of moderate, positive inflation, often about 2 to 3% to promote slow, but steady growth, as deflation weakens the economy and increases unemployment. But the central bank is in serious trouble when inflation starts to skyrocket. This is when the monetary policy comes into effect. Before we get into interest rate adjustments by central banks, let's take a look at how monetary policies work in an economy. What do you do when you need money to buy a car or a house? Usually, you visit a bank and apply for a loan. If all works well, the bank lends you money. Later on, you start paying the loan including interests. Likewise, commercial banks borrow money directly from the central bank to cover their most immediate financial needs. In other words, a central bank lends money to commercial banks, while commercial banks lend money to households and companies. A commercial bank must pay interest when returning the money it borrowed from the central bank. In this case, the cost of money is set by the central bank, which has the authority to set its own interest rates. These benchmark rates are the ones that central banks typically adjust to curb inflation. If the central bank charges commercial banks higher rates, the commercial banks will pass the higher rates to consumers and businesses. Due to the increased cost of personal debts, auto loans, credit cards, and mortgages, consumers become less likely to obtain loans. Companies that routinely borrow money to support investments begin to reevaluate the risk-return profile of their investments. Consumer spending will inevitably decline across most, or all economic sectors, as interest rates increased. Prices typically go down, as demand for products and services declines. Precisely this is what central banks are doing in an inflationary situation. Reduce spending to combat inflation. So, it is all about the interest rate? Not necessarily. The interest rate is not the sole instrument used by central banks to fight inflation. There are several other strategies for controlling inflation. Adjusting reserve requirements and open market operations are the other two most popular policy tools. Commercial banks are typically required to maintain a certain level of reserves, which is set by central banks. A bank can keep its reserve physically in its vault or kept in an account with the central bank. By changing the reserve requirements, the central bank can regulate the amount of money in the economy. The money supply will decrease if monetary authorities increase the minimum reserve requirement, because commercial banks will have fewer funds available for lending. The reserves cannot be used by commercial banks to fund new business projects or loans. Central banks pay commercial banks interest on the reserves, since it represents a missed opportunity for the banks. However, the rates that central banks pay are often a lot lower than the rates that banks charge to their creditors. To change the amount of money in circulation, the central bank may either buy or sell government-issued securities. For instance, central banks may sell government bonds when there is high inflation. Financial institutions use their money to buy government bonds. As money leaves the system, inflationary pressure is released. This is precisely what the central bank intended. However, the results of most of the above monetary policies can take up to 2 years to manifest, so they are unlikely to provide an immediate answer to the most pressing problems. Thank you for watching. Please consider subscribing, liking, and sharing, which means a lot to me. I love to see your thoughts in the comment section.